Now, in truth, I believe that credit has been too freely available for 10 years. We went through a very benign economic time in the 1982 to 2022 timeframe. And the consequence of that is that credit standards got lax. It was easy to put money out. It's a little tougher to get it back. And so you're seeing a tightening of credit standards simply because, as an example, you're seeing fewer people qualify for loans at higher interest rates. And you're beginning to see other forms of credit delinquency, people behind on their mortgage, people behind on installment debt, consumer debt. You're seeing credit card default rates increase. All of that, all of the circumstance where banks are experiencing more difficulty in getting paid back means that they are less likely to extend credit.
Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show where we think, act, and prosper. Today we have Rick Rule back on the channel. He's been on multiple times. Y'all know his name. We're going to talk a little bit about the symposium coming up, but how you doing today, Rick?
Daryl, I'm doing fine. It's nice being back on your show. Thank you for the invitation to come back. I'm looking forward to hosting you down in Boca Raton, Florida. I'm going to work you down there just as hard as you're willing to be worked. You know, these things you get out of them, what you put into them. So save your strength. We're gonna be coming at you with a lot of information.
Yes. I'm very, very excited, not only to be in South Florida, but I've been to Florida a couple of times, Tampa, Orlando, but I've never been to South Florida. So it's going to be a good experience for me. And then just to be in a room with so many brilliant minds and people that have, done this, for a good chunk of their lives, and sharing that knowledge and wisdom with the attendees. So I'm excited for that.
We look forward to it too. This is the 22nd year, I think, maybe the 23rd year that we've put on the symposium. But of course, we put it on for Agora Publishing for 10 years before that. So we're nigh on or maybe past 30 years doing this. And, after a while, Daryl, you do something long enough, you kind of learn how to do it. We sort of believe that we know how to do this now. And, hundreds of attendees over the years have come to agree with us.
Yeah. And I see that there's another boot camp. Another silver boot camp coming up.
We have a boot camp coming up. We are polling the attendees of the prior boot camp, and they will tell us what topic to discuss. We've done uranium, we've done silver, we've done electric and battery metals. So we gave the attendees of the prior boot camps a range of menu items, and they're going to tell us what we're going to talk about. Mm-hmm. My personal hope is that we're going to do royalty and streaming, but really it's up to the attendees what we focus on.
Yeah. That's a good topic to even get into. So I've been looking at silver lately. I've been thinking more about just it's just this economic outlook just seems very uncertain. And so I've been seeing that the premiums on silver have been very expensive, especially junk silver. And then I learned the other day, you want to use your junk silver first before you use like any type of premium American Silver Eagles or whatnot. What's your take on the silver market right now? It seems pretty, obviously this is like more the retail market, but what's your take on it?
Well, I think there's three things to consider. The first is that investors and speculators who are new to the precious metal space need to know that historically in a precious metals bull market, which I think we're in, that gold moves before silver does. The investment decision is stimulated by fear. And gold is the asset that people go to when they're afraid. When the momentum is established by gold and when the narrative comes to be established by gold, silver, because of its lower unit price, moves further and faster. It is arguable that we're coming into the period where market leadership transitions from gold, which has had a nice move of late, to silver. That's what's happened in the three previous precious metals bull markets that I've enjoyed in my lifetime. You make the good point with regards to premium. And I think you make the point too that junk silver may be more of a survival asset than a speculative asset, which is to say, if the economy ever gets so bad that people are forced into a barter or a true cash economy, the small denomination that you receive with a bank of junk silver might be precisely what you need to exist in very bad economic times. And so people probably buy bags of junk silver almost as a survivalist asset rather than as an investment or speculation asset. And as you know, too, and you correctly stated, the premiums on bags of junk silver are very high. When people shop for junk silver, what they need to do is contact more than one dealer, because you find out that occasionally dealers will run specials on bags of junk silver to attract customers from their competitors. And these sales can really lower the acquisition cost of your acquisition dramatically. So it's important to shop around. It is also true that lower denomination silver investment instruments almost always have a higher premium on them. And American Eagle silver coins have very high premiums on them too. For investors who can afford bullion, the premiums on, say, kilo silver bars are much, much, much less than the premiums that you would see on 1 ounce product, 10 ounce product, or on junk silver. So how one decides to allocate their capital around the silver theme is very important. I've chosen myself, although I have a reasonable inventory of old US silver dollars, to hold most of my own silver inventory in larger denomination bullion products, so that I obviate the premium that's paid on retail silver. Retail silver products appear to be in very high demand, irrespective of which dealer you talk to.
Yeah. I walked into a pawn shop the other day, and I saw the premiums. I usually pick up like some pre-64 quarters.
Yep.
And I did some digging and research on when quarters and dimes actually had silver in them, and started researching that and how they changed that in the 60s. But I used to buy those quarters from there, and then I saw some I think it was like Philharmonic silver ounces, and they were going for about $10 over spot. And I was just like, yeah, sorry, I just got to pass. I got to pass.
And often it's possible, if you find the right dealer, to buy bag. Well, we should also define junk silver, which is to say general circulation, U.S. currency, silver currency, minted pre-1964. Generally, if you don't buy a bag of mixed junk, but rather if you buy pre-64 silver dollars, the premium that you pay is lower. But that really depends dealer to dealer to dealer. What's the important part of this to remember is that you need to check with as many dealers as you're capable of checking with.
Yeah, that's good. That's good to know. How much of this is also related to the uncertainty in the banking sector, and we're now in this banking crisis. We had another bank get acquired by JP Morgan, and since the last time we were on, and then there was talk about, I think it was Western Alliance or something like that. So how much of this is related to that, where people are like, I need real money outside of the system?
I think there is a fair bit of that. I personally believe that that's probably an overreaction. I believe that your audience is sophisticated enough that they can read the statement of financial condition from a bank if they choose to do it, and they can keep cash on deposit in solvent banks. While I personally encourage gold and silver ownership for everyone, I also encourage keeping some liquidity in US dollars, but in solvent institutions, and not in institutions that don't pay you interest. One of the things that's happened very recently, Daryl, is that people nervous about the condition of their small bank have transferred their accounts from smaller banks, which traditionally pay decent interest rates, to very large banks, which traditionally don't pay interest. People are precipitating their very own private banking crisis. There are lots of solvent banks in the country which will pay you 4.25, 4.35. It's only when you go to the biggest institutions in the country, the JP Morgan Chases, the Wells Fargos, the Bank of Americas, that they propose to not pay you any interest at all, which is absolutely silly. I guess what I'm trying to say is everybody needs to use some common sense. You know, you own gold for protection, you own silver for speculation or real catastrophe insurance, but you owe it to yourself to have some cash because you may have a crisis yourself. You may have need for that cash. And as we've discussed before, Daryl, on your show, having high cash balances during times when there's volatility in the system and where there may be a liquidity squeeze could give you the tools and could give you the courage to take advantage of the market rather than being taken advantage of by the market. So yes, I'm encouraging cash. Yes, I'm encouraging silver.
Yeah. I learned something interesting yesterday. I had an interview with Alistair McLeod from Gold Money.
Sure.
And we were talking about the banking sector being able to raise interest rates and how credit is the amount of credit that's being lent out is reducing significantly, and we may see a credit crunch. Is that something that's in line with your view with where we're at in the current market and the economy with what the Fed's doing as well?
Very much. We are seeing constrained credit. Now, in truth, I believe that credit has been too freely available for 10 years. We went through a very benign economic time in the 1982 to 2022 timeframe. And the consequence of that is that credit standards got lax. It was easy to put money out. It's a little tougher to get it back. And so you're seeing a tightening of credit standards simply because, as an example, you're seeing fewer people qualify for loans at higher interest rates. And you're beginning to see other forms of credit delinquency, people behind on their mortgage, people behind on installment debt, consumer debt. You're seeing credit card default rates increase. All of that, all of the circumstance where banks are experiencing more difficulty in getting paid back means that they are less likely to extend credit. But something else is happening too, Daryl, and I think this is what Alistair was referring to, which is to say right now the banks are focused on repairing their own balance sheets. They need some money. The FDIC regards a bank with a 7% equity slice relative to total assets as being well capitalized. But one of the things that's happened is that the mark-to-market losses in their long-term lending portfolios and their loan portfolios and bond portfolios is such that the banks need to build up their own equity bases. And so rather than lending as extravagantly as they once did, the banks are keeping the money themselves, basically reducing their overall balance sheets, but reinforcing the equity component around the basic bank. So both of those things are true. For those people with good access to credit, credit is still broadly available in this market. But I think that you'll see the more marginal commercial credits become constrained. I think that you will see continued tightening of lending standards around real estate. And of course, continuing challenges around qualification with higher interest rates. I think that you will begin to see the imposition of higher median scores around revolving credit facilities, which is to say credit cards and consumer debt. So yeah, money's going to get tighter. money's going to get tighter.
hmm Yeah, and I know like usually when money gets tight, we see bigger drawdowns in the markets, and I think that's more. I don't know if a credit crunch and a liquidity crunch is the same thing. I'm assuming the same thing because the system runs on credit. Is that correct, or am I
Yeah,
understanding that?
no, I think one begets the other. I mean, certainly as an example, if consumer credit becomes constrained, people buy fewer cars, they buy fewer refrigerators, they buy fewer consumer items that are often financed. That ripples through the economy. Folks that sell cars and folks that sell refrigerators don't
Mhm.
sell as many. They don't make as much money. So their earnings get constrained. So maybe they lay off some workers. It is true that at least in the near term, generous credit is good for the economy. The problem with generous credit is that it always leads to mistakes.
Mhm.
And the mistakes always lead to market disruptions. I suspect that as credit gets tighter, that we may experience liquidity crunch, which is a different thing. It could be that the response to tighter credit is a lack of confidence in a market panic. I'm not saying that that's going to occur,
Mhm.
but there's always the chance of that. And I think the chance now is unfortunately particularly good.
Yeah, yeah. Today I was looking at the market, and today the inflation numbers came out, and the market's like rallying, right? And and so I have to like battle within my mind, because I'm thinking like, okay, we're in the middle of a bear market, and so like there's times where I take profits and such, but I'm not like as confident in the markets right now. I feel like the economic outlook does not look good. We are getting you know, some conflicting headlines regarding uh, economic data and such. Some is normally is phrased as like a positive, like, oh, it's positive. Inflation's at 4.9% year over year or whatever, and it's framed as a positive. And so like I feel like the market in this whole media thing is playing mind games right now. So how do you filter through that?
Well, I think that the media is playing mind games. The financial media needs their customers to be in the right frame, that they spend money on the products of their advertisers. If their advertisers Bank of America, then they got to make you think the banking system is sound. If their advertiser is an equity mutual fund, then they got to make you think that the equity markets are sound. One thing I would caution you on, Daryl, is not to pay too much attention to day-to-day moves in the market, because very few people make money in the market day to day. There's very few actual good traders, but there's a reasonable number of good investors. I think that you need to look away from the noise of the Dow is up 1.2% on the day, or the S&P 500 is down 80 basis points on the day. I think that you need to look at circumstances that you think are more likely to be true than not, and think about the importance of that. And I think that you need to participate in those trends with the understanding that it might take you 2 years or 3 years or 4 years to get paid. But if the outcome is a probability rather than a possibility, and you make investments where time is on your side, you're going to do well. It's very interesting to me that people that watch the market forget about price. If, as an example, the Dow were to fall by 50%, the Dow would be arithmetically twice as attractive. That's the way the arithmetic works. But when the price of something were to fall by half, people seem to refuse to buy it on sale. This is perplexing to me. I would just encourage you, Daryl, and I would encourage your listeners to focus on the value of something or what they perceive the value of it to be, because the price information isn't of much use if you don't have a feeling with regards to the value. If, let's say that there's a small stock, the kind that we talk about from time to time, and it's selling for $2 a share. And let's say you think it's worth $2 a share. If the price goes from 2 to 4, it's become very risky because of selling for twice what it's worth. But the fact that it went from 2 to 4 makes people feel good about it. And ironically, they are more likely to buy it if it goes from 2 to 4 than they are if it goes from 2 to 1. If it goes from 2 to 1 and the value stays the same, but the price gets cut in half, it's precisely twice as attractive as it used to be. But people who pay attention to price and price signals rather than value always get that transaction wrong.
Yeah,
I don't mean to laugh, but it is kind of funny.
Yeah, that's very true. I mean, because it has a lot to do with market psychology and how we engage with the markets. And and I've found myself, falling into those. I wouldn't say it's habitual, but I've done those acts before. Where I see something goes up, like, oh, I better get on the train before it leaves, and then you get on the train, and then you lose some of your money or whatnot. But when you were talking about that, I was thinking a lot about the classrooms that you have available on your site and your channel. And I think one of them I have on my watch list is I think how to investigate a company. And so that's on my watch list. But I feel like I need to get more knowledge and wisdom in kind of that area so I can know what the value of a company is. Like I have like a macro outlook and a longer term view where I know, like, okay, certain commodities are going to go higher because of X, Y, and Z. But then when you get into like specific companies, like I know how to read balance sheets, but actual valuations, like that's a deficiency of mine.
Yeah, and you have to address that. You have to get at it. And by the way, don't put off watching the video about investigating companies. The truth is that you won't get it all. You won't. But it's going to be there 3 months from now. It's going to be there 5 months from now. And by watching the video and identifying the shortcomings that you have in your own experience, you can address the shortcomings as they occur. One of the things I love to do myself is challenge myself with learning media that I'm not good at. And the consequence of that is that I force myself on a continuing basis to learn. While it's occasionally, particularly as a 70-year-old, where I assimilate information less well than I did when I was younger, it's occasionally embarrassing or humiliating to begin a learning experience that exposes to you just how ignorant you are with regards to that particular subject. But the only way you get better, the only way you get better is by engaging. So I applaud you in the first instance for wanting to learn more about securities analysis. And I would implore you that the right time to begin that process is today. Get at it. There's nobody watching you watch this video.
Yeah.
If there's a couple of minutes of it that don't make sense, that's okay. We have a question and answer function. So ask the question. We'll try and give you an answer.
Mm-hmm. Yeah, that's really good. I read a book on stock valuations. I think I use Lynn Alden's tool that she has as well. But I mean, math, like simple math is good, but some of the equations, I'm like, I don't know if y'all went to statistic courses or what, but it's
Well,
it goes over my
the
head.
important thing is to get the big things right.
Mm-hmm.
So many times I do valuation classes. I did one for Cal State Fullerton last week for the MBA students over there. And these poor kids actually believed that they were going to get valuation right. That's never going to happen. What you have to do is get it more right than somebody else does. You have to have a framework. When people ask me big picture questions, I sort of say, you know what? You don't need to know that. And you don't need to know it because you never can. Here's something I want to leave with you. U.S. 10-year Treasury pays you 3.4% in a currency that the Congressional Budget Office says is losing spending power at 7%. Now, that's real easy math. You take 3.4 minus 7. The outcome is not a positive number. What it says is if you invest long-term in conventional savings products, you lose purchasing power. You don't need to get this down to the BIP, to the 100th of an interest rate point. You have to get the big stuff right.
Hmm.
That's what's important.
Yeah, agreed. I've been using more of the savings products lately, just to be a little more risk off and to have that cash. Because I mean, usually,
You
obviously,
got
like,
you got to have you got to have cash around. The point I'm trying to make to your listeners is getting the big stuff right. People used to ask me questions about real estate, and they'd ask me all these questions like I know something about real estate, like even what color should you paint a house? I don't care. Here's what you have to know buying real estate. If your cost of funds stays steady, you have a 30-year fixed mortgage, and if fees and stuff and inflation means that fewer people can build houses to compete with you, and if you can raise your rents by 4 or 5% every year, in the long term, if you buy a house or buy a duplex or buy a triplex or buy a fourplex in an area where you're able to raise your rents, and if the price you pay generates a positive yield at today's interest rates, and if in particular you lock in today's interest rates for a 30-year term where they can't raise the interest rate on you, then real estate's a good investment. I'm not giving you this lecture to say real estate's a good investment. All I'm trying to say is that you need to understand how the investment works. It works because supply is constrained, because rents can rise, and because your cost of capital doesn't rise. And you make money on the difference between the cost of capital and return on capital employed. That's the important part of the lesson. And the same thing works in securities analysis. The same thing works in bond analysis. It's important not that people try to get it exactly right down to the penny. Won't ever happen. It's important that people understand the process enough that they get the big math correct.
hmm yeah, that's good. That's good to hear. Good to hear. I'm definitely gonna go check out that video investigating companies, and as well as a lot of the other ones. I saw some really valuable ones that I want to tap into, so I'm gonna do that this week. I had to finish off the class for college, but I'm good next week. So
Good.
Rick, appreciate you for coming on. Can you share more about the classrooms and then also the symposium coming up?
Well, the three things that four things I want to leave people with. I'll do them one at a time. The first is the best way to reach me and the best way to continue this dialogue is to go to my website, Rural Investment Media. If you invest in natural resource stocks, list them there, and I'll rank them for free. That's a really good price. No obligation, for free. The second thing is that we have a lot of educational material, including the Rural Classroom, where we're ultimately going to do a 60-part series on natural resource investing. I think we've got 11 parts of it done now. Absolutely free. You can learn the basics of investing, in particular the basics of natural resource investing, for free at the Rural Classroom. 4 times a year, we put on investor boot camps, where these are virtual conferences where you don't have to travel somewhere, but rather you can watch the conference from the comfort of your own home around specific subjects. We did the uranium boot camp, which I think you remember, the silver boot camp. Recently, we did the battery metals boot camp. 3 times a year, we do 8 hours on one subject. Very, very, very dense. It's very useful if you're going to attend the boot camp, if you have reviewed the classroom series, so that you understand all of the concepts that are being put forward in the symposium. The symposiums are $99. You have the ability to watch the symposium material at your house, not just on the day it occurs, but for 6 full months, which is important because 8 or 8.5 hours of material is more than you can consume and absorb in 8 or 8.5 hours. I put on the uranium boot camp. I've watched it 4 times since to understand it myself. But the point I was going to make is we charge you $99 for this. And if you don't think you got your $99 worth, email me. I'll give you your $99 back. Our premier investment product is a once-a-year live natural resources investment symposium. This year, we're doing it in Boca Raton. And this year, we're going to be graced by the presence of Daryl Thomas, which I'm looking forward to. We do this at the Boca Resort which is a mind-boggling place. Michael Dell has $1.4 billion into this hotel. 245 acres in downtown Boca, half a mile of Atlantic Ocean waterfront. If you went to rent a room there right now, Daryl, would set you back $1,100 a night.
Yeah.
I'm a bargain hunter. So because we rented a lot of rooms, they're giving them to us for $300 a night. And this is an absolutely spectacular hotel. But the Symposium is not about staying in a nice hotel, although it makes it painless. It's about some of the best big picture thinkers in the world. Guys like Bill Bonner, the founder of Agora, Jim Rickards, best-selling author, Wall Street lawyer, former CIA analyst, Nomi Prinz, a woman who talks about the Federal Reserve and Wall Street, having been in both of them. Grant Williams, who beats me in in polls as best public speaker at my own conference. Wonderful people in terms of establishing paradigm, but people that you won't see quoted on NBC or CBS, people who approach the world from a point of view more like yours and mine. Importantly, after that, we have some of the best analysts and money managers in natural resources in the world. We've been putting on this conference for 30 years. Got a great Rolodex of friends who have been serially successful over 30 years, who come and tell us how. But it gets better than that. Every year, we have 4 or 5 of what we call the living legends, people who have built multi-billion-dollar natural resource companies from scratch. They tell you what they're doing now, which is usually good information, but more importantly, they tell you how they built their last success from nothing to a multi-billion-dollar company. And those lessons can be very useful to you in learning how to identify upcoming managers, but also learning how the mistakes and the successes that they enjoyed made them better investors and can make you a better investor too. Like with the boot camps, this is an absolute money-back guarantee product. If you'd like to attend in person, we'd love to see you there. If you can't come, we're going to live stream this event so you can watch the whole event from your own home. Last year, 31 people from 31 countries around the world watched the live stream. And like in the boot camp, the live stream will be available to live stream customers and physical customers for 6 months after the event is over. So if 48 hours of programming in 4 days is too much for you to absorb, you will be able to refresh yourself with the lessons again and again and again for 6 months. The charge to attend this is $599 until June 30th. Once again, fully refundable. At June 30th, the latecomer surcharge comes on, so the price goes up. And as I say, it's absolutely, positively, fully refundable if you don't think you got your money's worth. Now, I need to say, in 30 years of offering up investor education products with full money-back guarantees, I've had to refund less than 0.1% of the tuitions I've charged. I'm absolutely confident that either the symposiums or the boot camp or both are worth everybody's time, trouble, and treasure to attend. I'm just making the financial risk mine, not theirs.
Thank you for sharing that. That's a lot of value that you are giving the people. I will have all those links in the description below, so be sure to go check out the classroom and submit your portfolio, and also the symposium. So thanks, Rick, for coming on today. Appreciate you and your time spending it with us in the audience, giving us some valuable lessons and education for us to absorb.
I look forward to that. Maybe next session we have, I'll propose a reading list for your son.
Right.
And I'll talk about how people need to invest in themselves and their education. In my declining years, there's nothing that gives me more pleasure than torturing young people with getting them equipped for the world that they're going to exist in. So maybe that's something we'll talk about in the future.
Yeah, that'll be great. That'll be great. Thank you.
Great. Thank you.